Now, in terms of FY25's budget, some of the sort of fiscal math have not really, some parts of it have not really panned out the way that was perhaps expected at the time of the budget. And the biggest, of course, is the capital expenditure numbers, which are trailing the run rate required to get to that budgeted target. So the sense we have is that we possibly are looking at a large shortfall in the current year. And for next year, we're hoping that we will get as much fiscal space as possible prioritized towards capital expenditure. However, the number should be something that is reasonably achievable in the year. Not sure that we should be looking at a very large fiscal deficit born out of a Capex number that inherently doesn't look like it can be practically rolled out within the year. So for the current year, with a miss of about 1.1 trillion in total expenditure, we are looking at a fiscal deficit coming in at 4.8% of GDP. This is taking into account the nominal GDP being slightly lower than what was penciled into the budget for last year. And for FY26, based on the revenue numbers, we feel that a fiscal deficit of 4.5% of GDP looks quite reasonable to achieve. And that should be able to allow us an 11 trillion capex, which would be a growth of around 12 to 13% over the number that we think is feasible for FY25. See, 11 trillion itself means that you need a monthly run rate of 1 trillion in every month other than maybe the 2 peak monsoon months, and that's quite a lot to achieve. My sense is that it's better to start with targets of say 11 trillion and 4.5% of GDP upfront. If in the first few months we see that Capex is actually rolling out much faster, then maybe an early supplementary could be considered to be able to up the Capex target. But upfront, putting in a larger fiscal deficit and Capex number and a larger borrowing program may not necessarily be very prudent. It would push up yields. I think it would be better to actually come in with a realistic Capex number upfront. And certainly if it looks like it can be overachieved, coming in with a supplementary in Q2 perhaps. For the current year, we're looking at a miss in capital expenditure of about 1.4 trillion as compared to the budget estimate of 11.1 trillion. Rural consumption hopefully will be a bit more steady this year after last year's good monsoon and abundant reservoir storage. Urban consumption is something which may remain quite uneven across the different income cohorts, and let's see, once food inflation starts to recede, maybe urban consumption can also get some see a little bit of an uptick. Some tinkering with the income tax slabs and rates, that does tend to give a little bit of a positive mood upliftment as far as urban taxpayers are concerned. So perhaps that is something that the budget can bring in without too much of a revenue loss. See, first of all, I think two major things that would be important. One, not to have too much revenue loss, and second, not to lose too many taxpayers out of the tax net. It's been a really great effort to bring in more taxpayers into our income tax net. Compared to other large economies, our number of income taxpayers is really very small. So by no means should we lose out on these very hard-won gains. So perhaps either a tinkering with the rates at the lower slab, or sort of inflation adjustment of the slab itself to give a little bit of relief right at the beginning. But perhaps we can look at the filers continuing to file tax while we are looking at a slightly higher slab itself for the initial income tax bracket. See, as an economist, I always prefer an investment-led growth. I think there is a lot that we need on the infrastructure side, and capital expenditure push from the government is also a quicker way of getting things moving in terms of the growth momentum. It creates a lot of positivity in the economy, and the virtuous cycle that gets set in place is something that then trickles down to other parts of the economy as well. I would definitely think that we've had a year where capex growth is likely to end up being very, very low in FY25, and certainly the fiscal space which is there should be prioritized for capital expenditure. Our forecast suggests that every 10 basis points of additional fiscal deficit could get us another 35,000 crore of capital expenditure. But like what I was saying earlier, probably better to start with a realistic capex number, a fiscal deficit which is going to come down in line with the medium-term forecast that had been mentioned earlier, and that would give us a reasonable borrowing figure for the markets to be able to absorb. So that's always being asked of the finance minister, tax relief, and inflation does eat away at disposable income, so it's not an unfair ask. But like I was saying earlier, hard-won gains in terms of increasing the income tax base. So I think while some modest concessions could be given in terms of tax relief, perhaps we really need to make sure that we're not losing out too many people from the income tax net.